Hey, welcome to another video. The age-old debate. Is Intel a dying company or a sleeping giant? It seems that every single quarter we hear the same story. Intel's losing market share to AMD, and along with it their competitive advantage that's allowed them to stay on top of the semiconductor game since the 1970s. Now, I'm by no means a tech genius, but in this video I want to explore Intel's business model in depth and figure out if it's really an investment worth making. Just as a disclaimer, I want to let everybody know that Intel is currently the biggest position in my portfolio. You can rest assured that I will try to be impartial in my analysis and expose both the positives and the negatives of this business, but take everything I say with a grain of salt. Please smash the thumbs up, it really helps the channel grow. Alright, let's begin. Intel's primary products are microprocessors and chipsets. For those like myself who know nothing about tech, a microprocessor refers to the brain of the computer that does all the calculations. They can also be called CPUs, which is short for Central Processing Unit. Chipsets, on the other hand, refer to connections between the CPU and the rest of the computer. Intel operates in two main business segments and a couple of smaller ones as well. The first is what they call Client Computing Group, or CCP for short. This segment makes up about 52% of their total sales and is largely considered Intel's legacy business. This segment encompasses chips that end up in personal computers, or PCs, and notebooks. The second important business segment is Data Center Group, which is where Intel makes data center processors for cloud service providers, enterprise and government, and communication service providers. DCG is usually regarded as Intel's growth avenue since the total addressable market for these industries is growing at an exponential rate. It is also important to note that data center microprocessors are a lot more profitable for Intel than PC microprocessors. Intel's smaller business segments include Internet of Things, Non-Volatile Memory Solutions Group, or NSG for short, and Programmable Solutions Group, or PSG for short. Internet of Things is separated into two subdivisions, Internet of Things Group and Mobileye. Again, for those who don't know what the Internet of Things means, let me read off the Wikipedia definition for you. Internet of Things describes the network of physical objects or things which are embedded with software, sensors, chips, and other technologies that is used for the purpose of connecting and exchanging data with other devices and systems over the internet. In case you haven't heard, this is an area that is very hot and hype in the investing world these days, probably because the total addressable market opportunity is huge with the whole world undergoing digitalization. Currently, this segment only makes up a bit over 5% of total sales for Intel. Internet of Things Group customers come from various backgrounds such as retail, healthcare, and industrial. Mobileye is the second subdivision of this segment. Mobileye focuses on developing camera-based software for autonomous driving called IQ, and on providing sensors as well as processing and communication systems for automotive companies. So far, their partners include BMW, Fiat, Volkswagen, Nissan, and Ford, to name a few. I won't really go into detail about the last two segments, mostly because they only account for 9% of sales. All you need to know at this point is that NSG provides memory and storage chips, while PSG provides a type of chip called FPGAs, which are basically microprocessors that can be configured by a customer after Intel has manufactured them. Intel used to operate its business using a tick-tock strategy. They would advance their microprocessor technology every 2 years to reduce feature sizes, so for example from 16nm to 14nm, that was the tick. And during the 2 years in between, they would launch changes in the microchip architecture, which from my understanding is the manufacturing process. That was the talk. As of 2016, Intel moved on from that strategy and adopted the process architecture optimization strategy. Now, instead of lasting 2 years, the new model lasts 3 years, whereby the third year is used to optimize the existing technology. The tick-tock strategy was simply no longer economically sustainable. As microchips become smaller and smaller, reducing their size becomes extremely complex and expensive. Now we can dive deeper and explore the strengths and weaknesses of this business. Without a doubt, the single greatest weakness for Intel is something that scares a lot of investors away, and that is rising competition. It seems that competitive pressure is hitting the business from every single angle these days, with AMD leading the charge. Historically, Intel had always been able to keep competitors at bay by reinvesting enormous amounts of cash back into research and development and coming out with better technology every 2 years or so. Smaller companies like AMD just could not keep up with this breakneck pace of innovation. This created a virtuous cycle where Intel would offer customers more performant processors for lower prices than competitors, which would lead to customers always picking Intel as a supplier, which would translate into more cash flow that Intel could reinvest back into R&D for better chips, and so on and so on. For many years, this cycle reinforced the company's dominance in market share for CPUs. However, it has got to be said that recently Intel has somewhat stumbled by delaying the launches of their 10nm and 7nm microprocessors. This delay has given AMD the time to launch their own 7nm microprocessor, which is equivalent to Intel's 10nm, and to steadily gain CPU market share quarter after quarter. According to Statista, Intel went from boasting 82% of market share in early 2017 to just over 55% as recently as Q2 2021. That's quite the fall if you ask me. Of course, the statistic alone has had the effect of scaring many investors away, and the stock price has been very volatile over the past 3 years or so. As a matter of fact, Intel pretty much fired its previous CEO, Bob Swan, because of these manufacturing setbacks. The loss of market share to AMD has also had the effect of fragilizing Intel's wide moat. In the past, it could be said that Intel held an incredible amount of pricing power. Since the best performing chips were made by Intel and customers had limited alternatives, Intel had the capacity to raise prices whenever the volume of sales faltered in order to maintain steady profits. Strong pricing power, offsetting falling PC chip volumes, has been a key earnings and revenue growth driver in the past. But Intel might not be able to use this strategy to its advantage in the future. Speaking of competition, big tech firms like Amazon, Apple, Microsoft, and Google have voiced their interest in entering the semiconductor market with their own chips. As a matter of fact, Apple has already started manufacturing their own chip called M1, which goes in all their Macintosh computers and iPad Pro tablets. Obviously, this did not bode well for Intel, who lost between $1.5 and $3 billion in annual sales as a result of the end of the partnership. As a little side note, I just want to make it clear that Intel brings in $77.87 billion in annual revenues, so this wasn't a catastrophic event for them. One important thing to note is that the chips fabricated by these tech giants use an ARM architecture, unlike Intel and AMD, who make chips based on x86 architecture. While x86 is mostly used in PCs and data centers, ARM is mostly used in mobile devices like phones and tablets. One could argue that these types of mobile devices are becoming increasingly more popular at the expense of personal computers, and that this could cause additional downward pressure on Intel's core business in the future. There are two final negatives about Intel's business that I would like to mention before we move on. The first is that the life cycle of Intel's microprocessors is rather short, lasting a couple of years at best. Just because Intel wins a contract to design a given PC or server model doesn't mean that the customer will want to repeat business with them. The second factor I want to mention is the cost of recent acquisitions for the company. In the past couple of years, Intel has tried to branch out by acquiring companies like Altera for FPGAs, Habana Labs for AI chips, and Mobileye for autonomous driving. Although these acquisitions represent potential growth avenues for Intel, they also create some risk due to the heavy price that was paid. For example, Intel paid 140 times earnings for Mobileye in 2017. Only time will tell if these acquisitions were really worth the money that was paid. Now that we've gone over all of the doubts and risks, let's go over why I'm so excited about the future prospects of this company. Intel is a major player in the semiconductor industry that, in my opinion, is poised for decades of growth. Think about the Internet of Things and think about the cloud. Are there any industries that will outpace these two during the next decade? I highly doubt it. The digitization of the world is a trend that is still in its infancy, and Intel will be one of the biggest beneficiaries of the shift from physical to digital. Same goes for artificial intelligence. And what to say about the promise of every car in the world being equipped with autonomous driving capabilities? According to Global Newswire, the total addressable market for IoT chips is expected to grow to $531 billion by 2026, while the total addressable market for AI chips is expected to grow to $253 billion by 2030. This growth can be seen in the numbers coming out of Mobileye. 19.3 million IQ chips were shipped in 2020 versus 2.7 million in 2014. Revenues from Intel's two major business segments have also been on the rise year after year after year. Growth in the data-centric business is not very surprising due to the boom of cloud applications in recent years. What's more surprising is that PC sales are also increasing steadily every single year. What I can see from this is that so far Intel is dealing with the threat of ARM chips and mobile devices decently enough that they are still able to grow their legacy cash cow business. One little caveat here is that COVID-19 has definitely been a factor in boosting sales for 2020 and the start of 2021. I think the fact that Intel is the biggest player in an industry benefiting from massive tailwinds can easily counteract the fact that they have been losing market share to AMD recently. Even if this trend remains and Intel's market share keeps eroding in the next couple of years, the business can still show net growth due to the expansion of the total addressable market. But just being a player in a growing industry isn't enough to be a successful business though. It's a well-known fact that growing industries attract more competition, thereby reducing margins and leading to less profits for each individual player. Take the automobile industry or the airline industry as an example. But Intel's wide moat and numerous intangible assets give me the assurance that the company will fully benefit from the trends we were talking about earlier. The first component of Intel's moat is the x86 architecture the company uses to build its microprocessors. Intel is one of two semiconductor companies that build their chips on the x86 ecosystem. And the other one is, well, you guessed it, AMD. The x86 ecosystem is used in the vast majority of personal computers and data center CPUs. Gaming computers are also an area where x86 is mostly used. A direct result of this x86 monopoly is that chip makers which use an ARM architecture like Apple, Broadcom, and Qualcomm have had an extremely hard time entering these markets. The switching costs for customers who want to switch from x86 to ARM are absurdly high. Also, as I mentioned previously, ARM chips are mostly used in phones and tablets. They are not efficient enough to take on the intense workloads needed for PC and server chips. This means AMD and Intel pretty much have a duopoly in this market, with Intel being the much bigger player. Again, something I do have to mention here is that although x86 has been the dominant architecture for cloud computing until now, technology advances occur very rapidly and the entire computing landscape could look very different in a decade. In my opinion, the second component of Intel's moat is the nature of the semiconductor business, which is an extremely capital-intensive business. In order to be and to remain a top player in this industry over the long term, huge amounts of cash are required for research and development. Intel also boasts a number of fabrication facilities worldwide that represent a tremendous cost advantage for an integrated company like them. In addition, these $20 billion worth facilities represent a considerable barrier to entry for potential new market entrants. Intel's revamped fabrication business provides even greater protection from downside risk thanks to the increased diversification of revenue segments. Many companies such as AMD, Nvidia, Apple, Broadcom, and Qualcomm, so basically all of Intel's big competitors, only design their chips and outsource the manufacturing to firms like TSMC. This means Intel effectively competes on two fronts: design and manufacturing. Let's talk about the manufacturing part first. Intel's fab facilities have been struggling to keep up with the pace of innovation since around 2015, when the 10nm process was first delayed. From what I understand, this part of the business is actually mostly responsible for AMD's technology catching up with that of Intel's. However, things seem to be turning around with the arrival of Pat Gelsinger as CEO. In his recent announcement of the new IDM 2.0 strategy, he unveiled the birth of Intel Foundry Services, as well as the plan to build 2 new fab facilities in Arizona. Next, I'll play a couple of seconds from a video released by Intel that describes the main objectives of the new strategy.
IDM 2.0 is our evolution. Here are 3 things to know about Intel's IDM 2.0 strategy. First, we will continue to build most of our products in Intel factories, remaining a global leader in chip making and process technology. Second, we will expand our use of external foundries to make some of our products. Foundries already manufacture a range of Intel products, from communications and connectivity to graphics and chipsets. Third, Intel Foundry services will serve the exploding global demand for chips. We will make them for fabless companies offering our world-class process technologies, advanced packaging, and a broad IP portfolio.
With this focus on increasing manufacturing production, the company hopes to be able to become the second largest manufacturer in the world by the mid-2020s, focusing on the US and Europe as key markets. Considering the current global shortage caused by the booming demand for chips, I think Intel is looking in the right direction with this move. Once again, the total addressable market is huge. I also really like the fact that Intel Foundry Services will work with the likes of Amazon, Qualcomm, and Microsoft and let these companies design their own chips with Intel. I believe this is a winning move since Intel was feeling the pressure from big tech companies starting to design their own ARM chips. Now it doesn't matter if Intel loses Apple as a client when they decide to use their own chips, since Apple will still have to come to Intel to get them manufactured. Essentially, Intel is trying to be a big competitor of TSMC down the line. But building these fabs will take time, and Intel can't sit around focusing on this part of their business without thinking of improving their own products. At the end of July 2021, Intel laid out its process roadmap outlining the technological advances they will make all the way to 2025. In order to regain their qualitative advantage over AMD, Intel will outsource some of its designs to TSMC while the fab facilities get built. In this way, Intel wastes no more time and stops AMD from running away with the technological lead. At this point, I need to make it clear that AMD is not currently ahead of Intel, they have merely caught up. It's a common mistake to think otherwise due to the nomenclature, but AMD and TSMC's 7nm process is actually equal in performance to Intel's 10nm process. And while I'm comparing Intel to its arch nemesis AMD, here are a few revealing statistics about the two businesses. In the past 12 months, Intel has made $77 billion in sales versus $13 billion for AMD. Intel brought in $16.3 billion in cash flow versus $1.7 for AMD, and Intel spent $13.5 billion on research and development in 2020 versus $2 billion for AMD. AMD might have caught up to Intel, they might be taking market share away, they might be growing a lot faster, but at the end of the day, Intel is still a much bigger firm with a lot more financial power. Can AMD really catch up to Intel's numbers and dominate the market for the long term? Possibly. But is it very likely? That's up to you to decide, but personally I don't think so. Unless Intel fails to execute the plan laid out in IDM 2.0, I see them turning the business around and taking back the lead. I especially trust the new CEO, Pat Gelsinger, who started working at Intel as an engineer in the 80s and became the first chief technology officer back in 2001. If anyone knows how to bring back Intel's superior business model from the late 90s and early 2000s, it's him. Now let's go over Intel's financials and I'll show you guys why I was interested in researching this company in the first place. Intel's revenues have been steadily increasing since 1986. Every so often it seems that the revenues plateau for 2 or 3 years. I think this is due to the fact that the semiconductor industry is cyclical. From 2016 to 2020, revenues increased from $59 billion to $77 billion, or 6% CAGR. That's really not bad for a company this large. Intel has a very respectable return on invested capital of about 17%. Considering Intel's working asset cost of capital is 4.5%, that means that for every dollar invested, Intel creates 13.5 cents of value for shareholders. To put it into perspective, for every dollar invested, AMD makes 4 cents, Broadcom makes 2 cents, Qualcomm makes 5 cents, Micron makes 9 cents. Nvidia is the only semiconductor business that is more efficient, making 19 cents for each dollar invested. Intel has $47 billion in current assets versus $24 billion in current liabilities. Long-term debt of $33 billion looks manageable as well based on their cash flow of $19 billion in the last year. Overall, the balance sheet seems healthy to me. One of the things I really love about management at Intel is that they consistently keep buying back shares. In the past 5 years, Intel has gone from having 4.85 billion diluted shares outstanding to 4.08 billion diluted shares outstanding. This is a reduction in shares of 16%. All this means is that every year, one share of Intel gives you the rights to a slightly greater piece of the profit pie. I love companies that use excess cash to buy back shares, especially if it's a company with growing cash flows like Intel. Mathematically, the business is becoming more valuable because it is producing more cash, but my shares are becoming more valuable artificially as well because I'm getting a greater portion of the total cash. Intel's free cash flow is growing year after year from 12 billion in 2016 to 20 billion in 2020, although it is likely there will be a little slump in 2021. Anyways, free cash flow over this period was $14.6 billion per year. With a 2.6% dividend yield, Intel currently gives out $5.6 billion in dividends. That dividend seems to be on the safer side since Intel still has about $14 billion per year to buy back shares and reinvest in the business. Intel has paid a dividend for the past 22 years and has increased it by 7% per year in the past 5 years. The average dividend yield over the past 5 years has been 2.5%, but if you take into account share buybacks, the total yield to shareholders has been a whopping 6.5%. So how much would I pay for Intel? Well, for a company of this caliber, with good future prospects and numerous avenues for growth, a diverse revenue stream, consistently growing cash flows, and an aggressive share buyback plan, I would gladly assign it a multiple of 20. Since the 5-year average free cash flow was $14.6 billion, I would pay $292 billion for this company. With Intel's current market cap hovering around $220 billion, I think Intel is currently undervalued and a good buy at this point. According to my calculations, Intel's fair value is $72 per share. With a share price in the 50s, I'm quite happy with the margin of safety. And that's the end of this video. Intel is currently the biggest position in my portfolio, so take this analysis with a grain of salt. Let me know in the comments section why I'm wrong about this company. I like having my opinion challenged, it gives me food for thought. And also, haters are my motivators. As always, remember to smash the like button and subscribe to stay up to date with the channel. See you next time.